Let's get some insights on the news that's shaping overall market action. For that, we want to welcome in Andrew Ahrens, founder and partner at Synergy Advisory Management Group. Andrew, thank you so much for joining us today. All right, let's talk about this batch of economic data that we've had this week. We got the weaker jobless claims. We got that CPI that wasn't, didn't derail the thesis around the Fed's path from here. We also got the new consumer sentiment data today. How do you interpret all of this?
Well, I still think it's all positive for the market as we, move along here towards the end of the year. I think, we're going to see probably 3 to 4 rate cuts going into next year, which is all positive for a lot of companies here in the market. So, as I had expected, markets hitting all-time highs, which they are doing right now, I continue to suspect that we're going to see some strength in the market moving forward.
Andrew, let me ask you this. Are you in the camp at all? Because now there's this, camp that's wondering if we could potentially see a jumbo camp. Are you in that camp? And if you're not, why would you push, or how do you push back on that view?
I basically think that, we're going to see some cuts and they're going to be, probably see a quarter point, several times. And, that's kind of what I'm looking at moving forward.
And then in terms of your market outlook through the balance of the year, obviously, we note that we're seeing record after record, whether we're talking about the S&P 500, the NASDAQ. Dow finally has been participating, not today, but participating in the party as it stands by the close of yesterday, and the day is still young. You're constructive on equities through the balance of the year. What sectors or themes do you see playing out as the biggest beneficiaries of a potential bullish run through the year end?
Well, we've seen a lot of tech leadership, and I continue to think we're going to see that. Companies with AI, or like I said, we're still in early innings here, and there's a lot of room here for the markets to move higher. A lot of stocks that I've been pushing the last 6 months have done extremely well, and I expect them to continue to do well. And a lot of them are the big tech stocks. The Metas of the world, Google, Amazon. Right now I've been watching Reddit, and I'm watching the growth that they've been having, the strong second quarter growth that they've been having in the digital advertising space, and they're doing very, very well. And I continue to like Amazon, which is one of my favorite stocks as well, and they're making a big push, right now into grocery, and that could do awfully well for them too. So there's a lot of room for Amazon to run. There's a lot of room for a lot of these stocks, in my opinion. And when rates come down, that's all good for these kind of stocks.
Let me ask you about Amazon. It has been an underperformer year to date. What is it that gives you the view that it can catch up?
Well, Amazon, they do some cost cutting when they have to. And, if they have to do that, they usually, it usually reflects in the earnings moving forward. And there's just so many areas. Logistically, they're doing very, very well with the consumer. They're trying to be really, really close to where everyone lives and being able to get goods and, to people right away, which is what people want. And, I just think that they're going to continue to outperform. You could see Amazon not doing as well as some of these other companies so far this year, but all of a sudden, we see like a quarter and Amazon does really well, and the stock then moves up quite a bit higher, which I think we're going to probably see here as we go and approach the fourth quarter this year.
Okay. And then let me ask you a little bit more about, I want to go to the point you made about Reddit, as that is on your list as well. Look, Reddit has already made quite the move, since the lows that we saw earlier this year, the April, May, even bumpiness that it had. Why do you think it has further room to run from here?
Well, they have, 50 million daily active visitors. They've increased, over the last 2 years by 33%. And, the integration of AI, I think, is going to still enhance user engagement. And, it's doing well in the U.S., doing well internationally, and then I expect that to continue.
Okay. And then for investors who are looking for opportunities elsewhere, especially outside of, say, tech or, even this social media play here, essentially, you like Dick's. It
Right.
has been an underperformer year to date. What gives you confidence that there could be a shift coming?
Well, they just closed that Foot Locker deal, $2.4 billion deal. And in my opinion, I think that they may have gotten that Foot Locker pretty cheap. And I think if they combined, synergies, I think that they could maybe, do very, very well. They're dominant in the sports apparel business. And I continue to think that, you know, uh, with their buying power and purchasing power, and they're going to do extremely well. And I think we're going to see that all play out maybe as we approach the holiday season.
And then I want to get a quick final thought from you, Andrew, on, so you're expecting 3 to 4 cuts through the beginning of next year. What gives you the confidence that the economy can handle that pace?
Well, I mean, the earnings are doing very, very well. I think that the cut should only make companies do better here, and we've been calling for this to happen for a while, and I think we're finally going to see it happen. And I think a lot of people were surprised with some of the earnings that we've had, and with lower rates, that's only going to make the market look quite a bit better here.
Okay. All right, Andrew, we'll leave our conversation there for today. We appreciate it. That's Andrew Ahrens, founder and partner of Synergy Advisory Management Group. Have a great weekend.